the world of personal finance is, let's be honest, a swamp.
That's a good word for it.
It's just so complex, right? It's dense with jargon. There's all this conflicting advice, and it's all wrapped up in these product brochures that are basically impossible to understand.
Right. And you get this feeling of analysis paralysis. There's so much information, so many different strategies and products being thrown at you that you do nothing.
Exactly. So today, our mission is pretty critical. We're going to try and cut through all of that noise and really distill the foundational long-term principles of personal financial planning.
And we really dug in for this one. We're talking about a deep dive into the core aims, the actual practices, and even the regulatory side of things that governs how financial planners operate.
Yeah, and this isn't about chasing hot stock tips or, the latest crypto trend. We are talking about the structural integrity of your entire financial life.
And that entire structure really rests on one foundational goal, and that is ensuring that an individual or a household has adequate income or resources to meet both their current expenses and, crucially, all their future needs.
That sounds simple, but I feel like it's deceptively simple.
Yeah.
Adequate resources. That means building a financial engine that can run, reliably for decades. It implies a future-proofing element to it.
Oh, absolutely.
Your current income has to do a lot more than just cover this month's bills.
It has to. It must provide for two non-negotiable realities. The first one is that long-term income gap. I mean, the inevitable time when your regular income stream will be non-existent or a lot lower. Retirement. And the second is managing the immediate expense gap. Covering those truly unexpected events, a sudden job loss, a medical emergency that can otherwise just obliterate years and years of saving in an instant.
So planning is really just. It's strategic risk management. It's the systematic creation of future cash flow. But why do we need a formalized plan for it? I mean, if I'm living within my means, isn't that enough?
That's a really common misconception. Living within your means is it's step one. It's absolutely critical.
All right.
But a comprehensive financial plan is the proactive process that makes sure your current efforts are actually optimized for your future requirements.
Okay.
It's a holistic approach. It starts by, measuring where you are now, your existing financial position. Then it meticulously evaluates what your future needs actually are, factoring in things like inflation and time. Then it sets up a systematic process to fund those needs. And then, and this is the part people forget, it commits to continuously reviewing and revising your progress.
So it's less like a static document and more like a continuous navigation system.
Exactly. A GPS for your finances.
Yeah, dynamic process to keep the ship pointed toward the target, no matter what storms pop up.
Yeah.
Okay, let's unpack this. Let's start at the absolute bedrock.
Yeah.
Financial security.
Right.
How do we define it? And what are the essential tools for managing those immediate risks?
To establish security, we first have to get really clear on the difference between income and savings. Savings is not just the leftover change at the end of the month.
Right.
It's the portion of your current income that is intentionally, purposefully set aside and applied specifically to creating assets. And those assets are designed to meet future requirements. It's allocated capital.
That word intentionality, I think that's key. And financial planning is in the process of streamlining all these moving parts, your income, expenses, assets, liabilities, so they're all aligned and working together.
Yes, in synergy. To manage both current and future needs, it's like building an organizational architecture for your long-term stability.
Okay.
And in that architecture, the most vital and honestly the most overlooked section is risk mitigation. Investors. They get so focused on chasing high returns.
Of course.
But our sources are crystal clear on this. You have to address security first. You just can't build a skyscraper on a cracked foundation.
So let's talk about that foundation. The first line of defense that all the sources highlight.
Yeah.
The emergency fund. Why is this so critical? I mean, everyone preaches it, but why?
The emergency fund is your immediate financial safety net. It's designed specifically to protect your investment capital from short-term life events. Its entire purpose is to provide for your expenses if your current earned income is interrupted for any reason at all.
Job loss, disability.
A long-term illness, a family emergency you have to travel for, anything. And without it, the moment your income stops, you are forced into an impossible choice.
Which is what? You're either taking on high-interest debt, like a credit card, or you're selling your long-term investments at what is probably a huge loss.
Precisely. If the stock market is down 20% the month you lose your job, The last thing you want to do is be forced to liquidate your retirement holdings just to pay the mortgage. You're selling low, locking in a loss, and destroying your future.
So how big does it need to be? Is there a magic number?
The general consensus is typically 6 months of essential living expenses.
Okay, essential. So not your vacation fund.
Not your vacation fund. We're talking mortgage or rent, utilities, food, insurance premiums, the bare bones, and sometimes it might even be up to a year's worth if your income is highly variable, if you're a freelancer, for example, or if you're in a very specialized field where finding a new job might take longer.
It's a shock absorber. It buys you time to recover without touching your growth assets.
That's the perfect analogy.
Okay, so that handles liquidity risk. Next up, life insurance. There are so many complex products out there. What is the fundamental purpose of this tool in a plan?
At its core, its function is income replacement and family security. Full stop. It provides adequate financial cover for a family's requirements in the event of the income earner's untimely demise.
So it's not really for the person who dies, it's for everyone who is left behind.
Exactly. And it's critical that planners calculate this figure not based on income alone, but on the capital sum required to fund the family's future needs.
What does that mean exactly?
Well, you calculate, how much capital would they need to pay off the mortgage, to fund a child's university education, and to secure a spouse's living expenses for the next 20 or 30 years. You're building a pot of money that can generate the income you're no longer there to provide.
And the distinction between insurance types is important here, right? I mean, term insurance seems to be what most planners favor.
Yeah, that's a key insight. Term life insurance is pure protection. It provides the largest amount of coverage for the lowest premium, which keeps your costs low and maximizes the capital you have available to invest elsewhere.
Whereas other types mix in investment components that are often not great.
They're often complex, high fee, and low return. Financial planning really prioritizes getting adequate cover over buying some kind of complicated product design.
Okay, that makes sense. Moving to the third pillar, health insurance. The sources frame this one a little differently, specifically around protecting accumulated wealth, not just, covering a hospital stay.
That's what we call the wealth preservation mandate. Think about it. If you have spent 15 years diligently saving, building a retirement nest egg, your corpus, you simply cannot afford to have that entire amount wiped out by a single catastrophic medical event.
Right.
Health insurance is the boundary. It's the firewall that ensures your long-term savings remain untouched, protecting that corpus from being consumed by acute medical expenses.
So if I'm hearing you right, these three things have to be rock solid first. Emergency fund for liquidity, life insurance for income replacement, and health insurance for corpus preservation.
Yes.
Then and only then can we really start talking about investment planning and figuring out how to grow the money for those future expenses.
Exactly. And, managing that complex, dynamic ecosystem is it's overwhelming for most busy people, which brings us to the value of a professional planner.
Yeah, let's talk about that. Why do high-earning professionals, people who are clearly very capable in their own fields, still need an external planner? Can't they just, read a few books and use a budgeting app?
They absolutely could, but they often lack two critical resources, time and specialized perspective. Most individuals in a busy, demanding professional life, they just don't have the time or, frankly, the specific expertise to recognize complex income and expense patterns, to accurately estimate future goals, factoring in a realistic inflation rate, and then to manage their assets and liabilities with the kind of detailed research and ongoing monitoring that's required.
It's a full-time job.
For a planner, it is their single focus. They are bridging that gap between the client's demanding life and the technical complexity of the markets.
So how does an investment advisor then actually apply that expertise? What do they do?
They possess that deep expertise to understand product dynamics. So the specific risk profiles and return expectations of, say, a specific corporate bond versus a global equity index fund, they understand that. And they match those dynamics to the specific situations and risk tolerance levels of the client.
There's a lot of research.
Heavy research, comparing various competing product options, making the most efficient choices based on the client's actual ability to handle risk. And central to that is strategic asset allocation.
Now that's interesting because a lot of software can rebalance a portfolio in seconds now. So how much of asset allocation is still specialized expertise and how much is just, maintaining discipline?
That's a fantastic distinction. While software can handle the mechanical execution, the rebalancing the specialized expertise lies in the top-down strategic decision.
The big picture.
The big picture. Asset allocation is the continuous evaluation of different asset classes, equities, fixed income, real estate, commodities, for their specific risk and return characteristics. The planner's job is to set the appropriate weights or percentages in the client's portfolio.
So like 60% stocks, 40% bonds.
For example, their job is to define that strategic mix and then, maybe more importantly, maintain the discipline to stick to it, especially when markets get volatile and emotions run high.
And that maintenance brings us back to the dynamic nature of planning. You said it's not static advice.
Not at all. Life changes, markets change dramatically. The process requires constant attention to changing market performances, a sudden interest rate hike, a major geopolitical event, a surge in inflation, and you have to match those with the dynamic changes in the client's life.
A career change, a new baby.
A new dependent, preparing for a child's university expenses. A plan that was perfect 10 years ago must be systematically modified today. And that dynamism, that's the core difference between a one-time product sale and comprehensive financial planning.
Okay, that continuous client-centric nature. It really sets comprehensive financial planning apart from, say, the typical transactional advice you might get from a bank broker. Let's really clearly differentiate those two approaches.
This is a fundamental distinction, especially in how regulators are starting to view the industry. Financial planning is a specific process that centers entirely on the client, their life context, their unique goals. General advisory, in contrast, can often be product-driven.
Meaning?
Meaning it's focused on selling a specific financial instrument, recommending a particular stock or a certain mutual fund, often without considering the client's overall financial health or other goals.
So the scope is just.
Oh, yeah.
It's vastly different. Planning is looking at the full spectrum: retirement, insurance, investment strategy, estate needs, the whole picture.
Precisely. Planning is comprehensive. It looks at the entire financial ecosystem. Typical advice often just looks at a small, isolated piece of the total requirement. And, goal setting, which we're about to dive into, is the absolute central pillar of financial planning. All activities are directed toward meeting those measured targets. Normal advice might offer a target, but it's not tied to a cohesive, lifelong timeline.
And if you only take that piecemeal advice, you risk having financial activities that actually conflict with each other. This is that synergy principle you mentioned.
The synergy principle is vital. Planning prevents conflicting strategies, ensuring all your money activities work together harmoniously.
Can you give an example of that?
Sure. Let's say you have an individual approaching their planned retirement age, maybe 60. If they only get advice on their brokerage account, they might take on too much stock market risk there. Comprehensive planning looks at all their assets, their pension fund, their investment property, their brokerage accounts, and it ensures their overall equity exposure across everything is systematically reduced to match their reduced ability to absorb losses at that stage of life. It's about total risk control.
That overall risk philosophy is also different, isn't it? A planner has to prioritize security, while a transactional broker might just be chasing quick returns.
That's exactly right. A planner selects what's suitable for the individual by considering both returns and, critically, risk. They're prioritizing the client's ability to withstand losses and meet their non-deferrable goals. Standard advice, especially if it's performance-based or commissioned, often ignores or downplays risk in pursuit of those higher headline returns.
A strategy that can be disastrous when markets correct.
It often is. And finally, there's the element of continuity. General advice is often a single transaction, a one-and-done deal, whereas planning is a continuous, iterative effort, monitoring progress against goals, performing annual reviews, taking corrective action to stay on track. That's inbuilt and natural to the entire planning effort. With general advice, the responsibility usually falls back on you, the client, to initiate that check-in, which can lead to neglect.
So if that continuous client-centric goal is the foundation, let's get into the specifics of goal setting, the famous SMART framework.
The entire planning process is it's useless without a destination. Goal setting provides that clear, non-negotiable target. Without it, you're just accumulating money aimlessly without the discipline or the time horizon knowledge you need to choose the right investments.
Okay, so let's apply the SMART criteria in detail, starting with S for specific.
The goal cannot be vague. We have to move beyond terms like being rich or having a comfortable retirement. The goal must be concrete and quantified.
So not be rich, but
I need to accumulate a corpus large enough to generate a sustainable, inflation-adjusted, six-figure passive income goal by age 65. Specificity defines the challenge.
which flows directly into M for measurable.
Right. Measurability allows you or your planner to know the exact amount of money needed, the final corpus, to achieve the goal. If you know you need, say, $2 million in 20 years, you can work backward. You factor in a conservative expected rate of return and inflation, and that tells you the precise amount you need to save every single month.
It transforms a dream into an equation.
Exactly.
And that work backward test immediately highlights the third criteria, A for achievable or realistic. This feels like where a lot of plans can fall apart.
Absolutely. A goal has to be achievable within your current or expected ability to save. If your calculation shows you need to save, let's say, $5,000 a month to hit your retirement target, but your actual monthly surplus right now is only $2,000.
You have a problem.
You have a fundamentally unrealistic goal. The planner then has to intervene to adjust, either by extending the time frame, reducing the target corpus, or, developing a serious plan to augment your income. Ignoring that gap just leads to failure and frustration.
And finally, T for time-bound, which imposes the necessary discipline.
Attaching a specific deadline, retiring in 20 years, funding a university education in 12 years, is critical. This time horizon dictates everything. The amount of risk you can take, the required rate of return, and the necessary savings rate. It turns a future wish into an immediate, actionable mandate.
Okay, so once goals are SMART, they have to be ranked. I mean, if we try to save for a vacation, a house down payment, and retirement all at once, we're probably going to fail at all three.
You're right. Goals should be ranked meticulously in order of priority. Non-negotiable, important needs like children's education and retirement must come ahead of luxury or highly deferrable expenses. This hierarchy is how the planner allocates your limited surplus saving capacity.
And speaking of immediate priority, the sources are really clear on this. Paying off high-interest debt like credit card debt is often the most important immediate goal, even if it doesn't directly add to your assets.
It's foundational financial health. Utilizing extra income to pay off a loan with a 20 or 30% interest rate it's a guaranteed return. It's better than almost any market investment you can make.
That's a great way to put it.
This repayment improves your financial condition immediately by removing that crippling interest drag on your future ability to save. You have to stabilize the negative returns before you can really focus on the positive ones.
It seems obvious that long-term goals like retirement should be prioritized, but we know clients consistently push them down the list. Why do people do that? Why this irrational deferral?
There are two main reasons, I think. First, just because they have time. That 20 or 30-year horizon makes the need feel non-urgent. It's easy to focus on more immediate, shorter-term consumption goals instead.
And the second reason?
Overconfidence. A lot of people rely on their employer-sponsored benefits, statutory retirement contributions, maybe a pension, and they just believe they'll be fully adequate. A core duty of an advisor is to test that assumption. You have to go through the detailed numbers with them, you project it all forward using realistic assumptions, and you demonstrate the potential inadequacy. You show them the gap.
Here's where it gets really interesting then. Let's talk about the compounding consequence of that delay. What is the real tangible cost of putting off retirement saving for just 5 or 10 years?
This is the single biggest catastrophic failure point in personal finance. Delaying saving for long-term goals drastically reduces the final accumulated corpus because that money loses the benefit of compounding.
You break that down.
Think of it this way. If you start saving $1,000 a month at age 25, that first dollar has 40 years to grow. It multiplies its value many, many times over. If you wait until age 35 to start, that dollar only has 30 years to grow.
So you've lost a decade of growth.
You've lost a decade of exponential growth. The difference isn't linear, it's exponential. To catch up, the 35-year-old has to save dramatically more per month just to reach the same number as the 25-year-old. The lost time is the most expensive thing you will ever sacrifice in financial planning. It's irreplaceable.
Truly irreplaceable. Okay, finally, in goal setting, a planner has to categorize goals into deferrable versus non-deferrable.
Right. A goal that's non-deferrable, like a child's university tuition, has to happen on an external timeline. It's tied to the child's age and their academic progression.
You can't just tell the university to wait a few years because you didn't save enough.
Exactly. So if your current income can't support all your goals at once, the planner's job is to advise pushing back or staggering the deferrable goals. For example, Buying a larger house might be deferred from 3 years from now to 7 years from now to free up capital for retirement savings today. So now that we have these measurable, prioritized goals, we can move to the day-to-day mechanics of managing the money stream. And we start with cash flow. It's really important to understand that a disciplined person who spends less than they earn can still have a severe cash flow problem.
Wait, how does that work? That sounds completely counterintuitive.
It happens when your inflows and your outflows don't align in their timing. You might get your salary paid monthly, but you have significant necessary expenses that hit, say, quarterly or even annually.
Like annual insurance premiums, property taxes.
Annual tuition payments, exactly. If that big annual outflow happens in a month where your cash reserves are low, you suddenly have a negative balance, even though your overall annual spending is perfectly fine.
And the cost of that mismatch is usually pretty painful.
It often forces the person to scramble for short-term borrowings, maybe a credit card cash advance or using an expensive overdraft facility. And these are extremely costly because of the high interest rates. So your long-term plan is being systematically damaged by these short-term interest costs.
So the solution is budgeting. But the personal budget in a planner's context has to be more than just, tracking your receipts at the end of the month.
Oh, much more. A budget is a precise, forward-looking list of your anticipated inflows and outflows over a specific time period, usually monthly or quarterly. It's a forecast, not just a historical record.
So what's the fundamental benefit that this budget provides to the planner?
The primary benefit is that it allows both you and the planner to see your exact immediate financial position, to determine if you're managing your income properly, and most importantly, to determine the actual monthly surplus you have available.
Okay.
We need to know that precise figure, your net monthly surplus after all taxes and any statutory retirement contributions, because that is the exact fuel that is available for funding your long-term goals.
So once your cash flow is stable and you have that predictable surplus, we can address the philosophy of borrowing. The sources have a powerful definition for this. Borrowing is using tomorrow's income today.
It's a perfect definition. It just encapsulates the opportunity cost so well. When you borrow, you are committing a portion of your future income to repayment, both the principal and the interest. And this directly reduces your future ability to save, to invest, and to compound wealth for retirement or other critical goals.
So when is debt acceptable? We need that critical distinction between so-called good debt and bad debt.
The distinction is really based on the utility of the asset you acquire with the debt. Good debt is generally used for appreciating assets or for assets that can generate future income.
The classic example being a mortgage for a house.
Exactly, property. It can increase in value and potentially generate rental income. But we should add some nuance here. Debt taken for, say, specialized higher education or for the initial capitalization of a small business can also be categorized as good debt.
Because it generates a future higher income stream, even if you don't acquire a physical asset.
Right. And then you have the less ideal or bad debt.
Cars.
That's the classic one. Debt for depreciating assets or for pure consumption. Cars lose value the second you drive them off the lot. They require maintenance. And then there's the most damaging, which is borrowing for regular consumption expenses.
Oh. So the rule of thumb is, it's okay to use prudent debt for a primary wealth-building asset like a home, but if you're relying on debt to cover your groceries, that's a clear sign you're living beyond your means.
A huge red flag.
But what happens when a client is already deep in that debt trap? They're relying on high-interest loans just to get by.
Yeah.
It sounds like the planner is almost acting as a financial therapist at that point. Is that counseling and hand-holding step more emotional than technical?
It becomes intensely emotional. The anxiety that comes with overwhelming debt can lead to really poor decision-making and often just avoidance. The advisor has to provide that counseling and objective hand-holding. You help the client analyze the situation without shame, and you often have to suggest uncomfortable but necessary measures, like maybe liquidating some illiquid assets or non-essential investments right now to pay off those excessive high-interest debts.
So the technical goal is to stop the interest bleeding, but the human goal is to restore stability and peace of mind.
You have to do both.
Okay, so moving from debt elimination to wealth creation. The core focus of investment planning is choosing the right assets for specific goals. And you said it's driven by that top-down allocation approach.
That's right. The advisor starts with the macro view. How much money is invested in which major asset class? Equities, fixed income, real estate. The goal is to deliver the expected returns while staying strictly within your stated risk preference and time horizon.
And that broad allocation decision is more important than picking specific stocks.
It's responsible for the vast majority of your long-term returns. Far, far more important.
Now let's bring in a massive variable, taxes. How profoundly does the tax regime affect a planner's strategy?
The tax regime is completely inseparable from achieving your goals. It often dictates which products you choose. It affects three things: the amount you save, through deductions, the returns you earn through capital gains or interest tax, and as a result, the total corpus you build for the future.
So different assets are taxed differently.
And even the same asset held for different periods of time can be taxed differently. This means the planner has to focus exclusively on the post-tax reality.
The post-tax return.
Absolutely. That's the actual real return after all taxes, capital gains, dividend tax, whatever it is, have been paid. It's the only number that truly matters in your forecast. We have to consider that post-tax figure when choosing products and estimating the holding periods, because a high pre-tax return that's heavily taxed might be way less efficient than a moderate tax-advantaged return.
But you mentioned a critical cautionary principle here, something that often leads to failure.
Yes. Tax efficiency should never, ever be the primary basis for an investment decision.
Say more about that. That feels like a trap people fall into.
It's a huge trap. Clients are tempted by a small tax deduction, say a 10% tax saving, and they end up buying these low-yield, high-cost financial products. Certain insurance plans or structured products are famous for this. They lock up your capital for decades and generate terrible returns.
So they're destroying 90% of their wealth creation opportunity just to chase a 10% tax break.
Precisely. The decision has to be based on your fundamental requirements and your risk appetite first. Tax optimization is just a tool to refine an already sound decision. It's not the reason to make the decision.
As we transition into the longest planning horizon, we come up against the biggest financial challenge of all, retirement planning.
Yeah.
Which, as we said, is often ignored or perpetually deferred.
It's deferred largely because of its sheer complexity and the fact that the need just feels so distant, but the complexity is undeniable. It's driven by two fundamental economic concepts that you absolutely have to master: the time value of money and inflation.
Let's start with inflation. If someone needs, say, $50,000 a year to live comfortably today, what does inflation do to that number in 20 years?
Inflation systematically erodes your purchasing power. If you assume a conservative 4% annual inflation rate, that $50,000 you spend today will require over $109,000 in 20 years just to maintain the same standard of living.
Right.
So these two concepts, the time value of money, which is your ability to grow capital, and inflation, the erosion of purchasing power, they're critical because they determine the future, significantly higher cost of meeting your expenses. You have to calculate the corpus you need based on future dollars, not today's dollars.
And we touched on that client overconfidence earlier, the reliance on existing benefits.
Yes, this belief that standard pension benefits or employer-sponsored plans will be entirely adequate for a comfortable retirement. It's a persistent psychological barrier. So a core, non-negotiable duty of the advisor is to run the detailed projections.
To show them the numbers.
To go through the actual numbers with realistic assumptions for inflation and market returns, and to demonstrate any potential inadequacy. That often serves as the necessary wake-up call to motivate immediate increased savings.
So as that retirement date gets closer, say in the last 5 to 10 years, the strategy has to shift entirely, right? From accumulation to capital preservation. How does rebalancing manage that finish line?
Rebalancing becomes paramount. As the goal date nears, the portfolio has to systematically shift from higher volatility growth assets like equities to less volatile assets like high-quality fixed income or cash equivalents.
So you're taking risk off the table.
Exactly. The focus is no longer on chasing maximum growth, which carries a significant risk of short-term losses right when you can't afford them. The focus is on ensuring the stability of the capital you've already accumulated.
Now the goal changes.
The final goal shifts to determining the exact level of required retirement expenses and then structuring the portfolio so that the stable, less volatile investment income is adequate to meet them.
Okay, so once we've secured the individual's own lifespan, the final planning horizon is estate planning.
Estate planning is all about legacy and transition. It refers to the specialized activities focused on the smooth, legally compliant, and tax-efficient transfer of wealth to your designated heirs, to charity, or other beneficiaries upon your death. It's about minimizing conflict and maximizing the value that gets passed down.
And this involves clarifying the two main instruments, gifts versus wills.
The key differentiator is really timing and legal control. Gifts can be exercised during an individual's lifetime. You transfer assets immediately, which can often have tax advantages depending on the jurisdiction.
And wills.
Wills, on the other hand, are documents that only come into play after death. They dictate how the estate will be legally distributed according to the client's final wishes. Both require very careful planning to ensure they're tax efficient and legally enforceable.
Now let's zoom back out and look at the overall measurement of financial health. Stability seems to be the true operating measure.
Financial stability is achieved if the household's expenses are consistently managed within the income stream, and there is a reliable, measured surplus that's dedicated to saving and investing toward goals. Once that stability is achieved, we can look at the assets themselves and how we classify them.
Right. Assets are broadly categorized into physical and financial. Let's start with physical assets.
Physical assets include things like real estate, gold, other tangible precious metals. Their primary advantage, historically, is that they often act as an inflation hedge.
Their prices go up with inflation.
They generally show a positive correlation with rising inflation, which preserves your real value. They offer a tangible store of value.
But they come with some significant drawbacks, especially around liquidity and access.
They are notoriously illiquid. It can take months, sometimes a year or more, to sell a piece of real estate when you need cash. They also lack the rigorous standardization and regulatory oversight of financial markets, and they are typically large-ticket investments.
Meaning you need a lot of money to buy them.
You need substantial capital or debt to acquire them in the first place,
Right.
which limits your ability to invest incrementally.
Okay, contrast that sharply with financial assets.
Financial assets are abstract claims on benefits, periodic interest payments, dividends, or repayment of principal. These include stocks, bonds, mutual funds, bank deposits.
And their big advantage is liquidity.
If they're publicly listed securities, they enjoy very high liquidity. You can usually sell them within minutes. And crucially, their evaluation is highly efficient because they are standardized products, and mandatory regulated information is made publicly available, which fosters transparency.
The sources mention a specific risk related to leveraging financial assets. Why is borrowing to buy stocks, for instance, considered particularly risky?
It's due to the high inherent volatility of financial assets. If you borrow or leverage to increase your exposure and the market drops suddenly, which happens frequently in equity markets, the leveraged investor faces amplified losses. It can lead to margin calls and rapid forced liquidation of their entire portfolio. The risk profile is just magnified by the borrowed funds.
So what does this all mean then? We've looked at cash flow, debt, and assets. The final defining measurement of accumulated wealth is net worth.
Net worth is the ultimate bottom line. Total assets minus total liabilities. It is the true quantitative measure of your accumulated wealth. A higher number indicates a better, more secure financial position for the household.
Okay, I agree it's the scorecard, but I have to challenge that assertion that net worth is the true measure of financial security. What about illiquid net worth? If my net worth is high, but 95% of it is tied up in a family business that takes 5 years to sell, am I truly financially secure against an immediate emergency?
That's a critical challenge and a great point. The planner must look beyond the absolute number to assess the liquidity of that net worth. High net worth tied up in liquid physical assets or a non-public business means you have high wealth, but you have low financial security in the short to medium term.
Right.
The plan has to ensure that the liquid financial assets component is sufficient to cover, say, 5 years of expenses without having to sell those illiquid assets prematurely at a bad price. It's the balance between growth-oriented illiquidity and security-oriented liquidity that defines true financial health. So, what does this all mean?
We've discussed the philosophy, the goals, the mechanics. Now let's formalize the operational roadmap, the standardized 6-step process that any comprehensive financial planner should be following.
This structured process is really mandated to ensure consistency, ethical practice, and completeness. So step 1 is defining the client-planner relationship. This is crucial for setting expectations.
What gets decided here?
You agree on the scope of the work. Is it a full, complex plan or just advice on one specific segment? You define responsibilities and you confirm the terms of engagement and the fee structure. It's the contract.
Okay. Step 2 is the data intake, gathering client data and setting clear goals.
The planner has to define financial goals precisely using that SMART criteria we talked about. How much money is needed, and exactly when is it needed? This involves meticulous collection of background data, family structure, detailed income and expenditure, existing assets, obligations, and the client's deep-seated tolerance for risk.
Once you have the data and goals, step 3 is the intensive assessment, analyzing and evaluating the client's current financial status.
This is where the heavy lifting occurs. The planner rigorously assesses your current position regarding income, expenses, assets, liabilities. And the key purpose of this analysis is to determine your current ability to save versus your calculated need to save to meet the goals.
It shows you the gap.
It clearly reveals the financial gap that has to be closed through corrective action.
Step 4 is the crucial creative phase, developing and presenting recommendations.
Based on that gap analysis, the planner proposes a concrete, actionable plan. This might involve suggesting strategies for augmenting your income, implementing strict controls on excessive expenses, or strategically reallocating existing underperforming assets to better match your goals and risk profile.
Then we move to action with step 5, implementing the recommendations.
This is the execution phase. It involves actually executing the proposed plan, completing necessary legal paperwork, setting up new investment accounts, changing asset allocations, or initiating those focused debt repayment strategies we talked about.
And finally, step 6, which you said cannot be overstated, monitoring.
Monitoring is a continuous, perpetual process. It is the lifeblood of the plan. Its purpose is to ensure the plan remains aligned to your goals as your personal situation evolves, a job change, a marriage, or as market performance shifts, like in a recession or a boom.
So you're making course corrections.
The final goal of this step is to make necessary revisions and course corrections to ensure the plan stays mathematically on track. Without continuous monitoring, even the best plan will inevitably drift and fail over time.
That entire 6-step structure sounds ethically sound, but only if the planner is truly acting in the client's best interest. And this field is fraught with potential conflicts of interest. We need to address the regulatory landscape head-on.
This is paramount. The potential conflict of interest arises when an intermediary earns their revenue not primarily from you, the client, but via a commission paid by the producer of a financial product.
Like an insurance company or an asset management firm.
Exactly. The planner's incentive can then shift from your welfare to maximizing their own commission.
And that incentive structure leads directly to the risk of mis-selling.
Mis-selling is defined clearly. It is selling a product that is demonstrably not suitable for the client's needs, time horizon, or risk preference in a manner that is harmful to their financial interest. And it's typically driven by the incentive to push high-commission products, even if they're a poor fit.
Regulation in major global jurisdictions has sought to differentiate clearly between the unbiased party serving the client, the advisor, and the party selling the product, the distributor.
That's why regulators like the Securities and Exchange Board of India, or SEBI, mandate segregation. Advisors, to remain truly fiduciary, should earn their revenue solely from the client. That ensures their advice is unbiased. Distributors, conversely, earn commission from the product producer.
So anyone offering financial advice for a fee?
For a consideration, as they call it. Anyone compensated for it must be registered and regulated under strict fiduciary rules.
And this regulatory push gives rise to the necessary fee-only model.
A fee-only advisor earns income primarily or exclusively from structured fees paid directly by the client for comprehensive financial planning services.
How are those fees structured?
They can be structured in a few ways. A large one-time fee for creating the plan, an ongoing asset-based fee, a small percentage of the assets under advice, or a specific fee for services like portfolio construction or tax optimization.
And their entire business is structured to deliberately avoid commissions, guaranteeing that higher standard of advice.
Yes, they avoid being financially influenced by product manufacturers. In some markets, individual advisors are explicitly barred from undertaking both advisory and distribution functions. You have to register as one or the other to maintain a clear line of duty.
Let's clarify the specific segregation rules for larger advisory businesses.
For non-individual or corporate advisory firms, they have to implement a stringent system of client-level segregation. This means they must maintain an absolute arm's-length relationship between their advisory division and their distribution division.
So they need a firewall.
A strong one. It often requires separate business units, physical segregation, and strict internal controls to prevent sales targets from influencing the objective advice given to advisory clients.
But the sources also noted that individual advisors can still provide execution services, even if they are fee-only. How is that possible without triggering the conflict of interest?
They can, but only by directing the client toward direct schemes or non-commission-based products. A direct scheme means the investment is purchased directly from the asset manager or issuer, and no commission is embedded in the transaction or the fee structure.
So the key is,
The advisor must receive zero consideration, zero commission for providing that execution service. That keeps the revenue stream clean and entirely client-centric.
finally, let's briefly look at the pure execution side of the industry, outside of deep planning. First, execution-only services.
Their core function is purely transactional. They distribute financial products, and their income is derived entirely from commissions paid by the product manufacturers. The focus is on facilitating transaction volume, not on holistic long-term planning.
Then there's the aggregation model. I need a clear definition of how this works and who it serves.
The aggregation model is a massive back-end platform that's designed to serve the distributor, not the client directly. It's an entity that shortlists products based on extensive research and then provides a streamlined execution platform for associated distributors and agents.
So they're helping the salespeople scale their business.
Exactly. By providing expensive research, training, CRM software, and the administrative backbone, the model is focused on supporting and scaling the sales pipeline.
And lastly, the modern technological solutions. Wraps and platforms.
These are highly automated technology-based solutions. They often offer standardized model portfolios, predetermined asset allocations for specific risk levels, and they facilitate the execution automatically.
How do they make money?
Their revenue model often involves charging a small, standardized fee directly to the client for the platform service, and sometimes they share that fee with the advisor or distributor who executed the initial transaction. They're all about automating the process of selecting and executing predetermined asset allocations for efficiency. #outro.
Wow. This has been a necessary journey. We've moved all the way from the simple concept of ensuring you have adequate income to the technical reality of regulatory segregation and fee structures.
The definitive takeaway, I think, is this. True planning is holistic, it's continuous, and it is disciplined. It mandates prioritizing comprehensive risk management, your emergency fund, your insurance, your debt elimination before you ever start chasing high returns.
And everything has to be anchored by that SMART criteria, using specific, measured, and time-bound goals as the navigational chart. And for you, the learner, understanding this planning environment is so vital. We saw how essential it is to know how your advisor is compensated fee versus commission, to make sure the advice you're receiving is truly unbiased and aligned with your long-term goals, not the planner's short-term commission targets.
At the end of the day, knowledge is most valuable when you understand it and you apply it. This entire comprehensive framework is designed to help you synthesize all your financial activities, the saving, the spending, the investing, so they stop being fragmented, separate decisions, and start working together as a single, powerful financial machine.
We discussed how retirement planning, as that finish line gets closer, requires systematically shifting your portfolio to less volatile assets. So given that traditional financial assets are standardized but volatile, and physical assets are illiquid but a traditional hedge against inflation, how does a global shift toward high-frequency trading and the proliferation of newer, less regulated digital assets, which have extremely high volatility but can be highly liquid, how does that complicate the conventional understanding of rebalancing for the modern pre-retiree? Should liquidity now outweigh volatility, even in the preservation phase? What stands out to you?
Thank you for joining us for the deep dive.
We'll see you next time.